Good morning, and welcome to the Atlas Merchant Capital Quarterly Financial Update Call. I'm Jim McCann, the host for our call, and joining me today, as always, Bob Diamond, the co-founder and CEO of Atlas Merchant Capital, and Larry Kantor, the esteemed and steamy chief economist who's followed Bob around the world, performing that function for him for decades now. The quarterly calls that we've done have been very helpful and beneficial to all of us who operate businesses, who have assets, who want to have assets, who want to grow assets, and you two have been amazingly prescient. I frankly don't remember a call that we've had that has been more needed, urgent, and set in a sea of questions like we're facing in the post-Liberation Day of last week with the imposition of these tariffs. Let me start with you, Bob. One of the things I've admired about you and your career is that you've lived through and managed through and led through all different kinds of financial crises in your career. Some I think that you caused yourself. Others were of the macro environment variety.
Never.
Bob, how do you think about leading in a time of uncertainty? How do you think about what indicators you look at? Larry's been your sage partner for many of these experiences. So what do you look to say, where are these seas going to separate and part, and what will it look like on the other side? And then as you're going through these times in a leadership role like you are today, what is it do you feel is important that you project for your communities who are looking to you for that guidance and leadership and sense of whether or not I should be panicked?
Yeah. Listen, I think this is a serious situation, Jim. I think, to be perfectly frank, in a time of crisis, I find it very comforting to look at the real economy, not just the markets and the stock markets and the interest rates, because I think over time they will get to a good place based on the underlying fundamentals. Speaking of the underlying fundamentals, I'm going to be perfectly frank. I think this action on tariffs is the most profound act of economic self-harm that I can recall in my life, certainly in my career. It's all self-imposed. I think we've talked before about tariffs having some role in balancing some inequities in trade. I think other people have said they're useful maybe up to 10%. If you go back to 1930, when we had Smoot-Hawley.
You were a young child at the time.
I was very young at that time. I was a little younger than you then, Jim. And, imports as a percentage of economics in the U.S., of the economy in the U.S., was 3 to 4%. Today, imports are 11% of our economy. That's $3.3 trillion. And what's happened is that the tariffs, which were 2.5% when President Trump was inaugurated, are now 22, 23, 24%. If you play with those numbers, that's $700 billion impact if nothing else happens on retaliation. So it is a serious situation. And I struggle to see which sector of America is better off, which sector of citizens, which sector of consumers is better off.
And industries.
With tariffs here, and industries.
Yeah. Larry, we had occasion to chat last week. I know you and Bob are in constant touch, but the world's a very different place today, or seems to be. As Bob just pointed out, you have to be careful not to just read the markets and assume that translates to how the underlying economy is doing. If you would, give us a couple of different answers. And I'll jump ahead a little bit with your caution last week, which is don't panic. Let's look at things today. Let's look at things 90 days out, 180 days out, and 365 days out. But where were we economically pre-Liberation Day? Where are we as we're in the middle of some very choppy seas here on Monday, April 7th?
You're right, Jim. I mean, this is very tough to all put together. And I've spent the last few days just trying to bury myself in all the tariff details and what's going on in the economy and the markets. I would say one thing. I mean, I think the focus right now in terms of markets is the stock market, which obviously taken a tumble, still going down as we speak. I would remind everybody, I think
It has an economic impact, but more importantly, an emotional impact, doesn't it?
definitely, yeah, it's definitely going to hit confidence both on the business and household size, and it is doing that. But I'd caution in the sense that if you sort of go back over the last year or so, the stock market's been booming a lot more than the economy. So, before all these tariff announcements, if you'd asked me what do I think of stock valuations, which I've been asked, they were on the high side. Whichever metric you use, PE, cyclically adjusted PE, price to book, all these things were high. And so there was more potential for that to crash than the economy because, as you said, when you look at the economy, it's been remarkably resilient and it's on very solid footing. We just got an employment report for March where people predicting job increases of 130 to 150, and it was over 200,000. The unemployment rate's been between 4 and 4.2, which is basically full employment since last May. But by the way, one thing you can pull out of the labor market, the employment report, is a sort of estimate of what income is doing, because you multiply the jobs by the work week, by wages, and it's been growing almost 5% at an annual rate over the past 3 months. So,
And we haven't seen that in the most recent few years. Wage growth has not kept up, right, Larry?
no, well, this is total, including jobs and how many hours are worked. It's just gives you an early indicator of what's going on with household income, which is positive. Consumer confidence is nosedive. Everybody's seen that. It actually is true. If you look, it's not that highly correlated with actual spending. One thing I love to look at is car sales because it's a real number. It doesn't get revised. We don't have that many manufacturers. You get it very quickly a few days after the end of the month. March car sales were over 18 million units at an annual rate. And by the way, this is the biggest purchase people make other than a house. So, it's a good measure of that they're feeling pretty good.
Was that a pull forward, do you think, Larry?
Well, I think a lot of it was pull forward, no question about it. But just to give you some sense, we haven't seen 18 million since just after COVID, when it bounced. It was running 16 and a half. No doubt, Jim, people are buying them now because they know the tariffs are coming. And the automakers are pulling them in.
Was there a mixed difference between domestic autos and foreign?
I haven't seen those numbers, but it's kind of complicated because, as you know, a lot of foreign automakers make their cars here. GM makes half their cars outside of the country. So even if you have those numbers, by make, you can get them, but it really doesn't tell you until way later. We're not going to know that. And then you look at balance sheets. One thing I like to look at is the debt service ratio. In other words, people look at debt to income, but that doesn't make any sense to me. One's a stock, the other's a flow. But if you look at total payments on debt divided by income, it's on the low side. In other words, it's around little over 11%. Just for reference, it got to almost 16% before the financial crisis. So consumers had a much higher debt burden than they do now. It usually averages around 12. It's a little on the low side. Then you look at the corporate sector, and net profit margins are very high. We've got a nice rate of investment. So things have been sailing along here, despite, a funds rate, as Bob said, that's, over 4%, which is not low. It's 100 basis points lower than it was. So that's a good thing. In other words,
but it's in that range you talked about on the last call. Both you and Bob talked about the 20-year average pre the financial crisis was in that 4-5% range, 4-4.5, right?
Right. And then it's been 1%, which is unusually low. So maybe it's normal. I think we're in an era of somewhat, not really high inflation, but higher inflation. Never mind the tariffs. But, let's put it this way, Jim. The recession risk is real. It's good that we've got such solid economic.
Is that different a week later?
What's that?
Is that different than it was a week ago?
Oh, yeah. Well, until the announcement, more than a week ago, once we saw these tariffs, as Bob said, you go from an average rate of about 2% tariffs to the 20s. This is the highest average tariff rate we've had since 1909. in Smoot-Hawley, which is infamous, which made the Depression a lot worse, it was around 20%. And as Bob said, imports were a much smaller part of our economy than they are now. So this is a big deal. This is definitely going to raise prices. It's definitely going to lower output, no question. In many respects, I mean, as Bob said, we are so integrated. Our production processes are so integrated with other countries right now. And like the car industry is a good example where they've put 25% tariffs. The US auto industry has pretty much survived by integrating with companies in Canada and Mexico. These parts and supplies go across the border many times before they're a finished product. And they can't react to this quickly. So this is going to hurt output. It's going to raise prices quite a bit. Tariffs are like a business tax. Don't forget, this is big on the household sector. I don't think people appreciate how much free trade has been a boon to the United States. So we've had trade deficits every year since 1975. Okay. And what's happened? We've had solid economic growth and, if anything, lower inflation. We haven't gone back to that 70s, early 80s high inflation. And free trade's a big reason. Yes, it's
What's
true.
the other side of that coin, Larry? What's the negatives of that?
Right.
We hear
There
a
are
lot
winners and
about
losers.
strategic investment in manufacturing infrastructure. I wonder, with our use of depletion of weapons in our arsenal in aiding of conflicts around the world,
Right.
can we remanufacture those without access to trade with different countries like China?
Well, China has already, as you know, retaliated with 34% tariffs. And by the way, there's also export restrictions, including, to get to your point, Jim, on metals that are used to make microchips. So this is a big deal. And you, as you said, there are negatives to free trade. I mean, China and other developing countries have hollowed out our manufacturing sector, no doubt, and that's had a big effect on a lot of cities that depended, that hosted these manufacturers. But the positive is that hundreds of millions of Americans have been able to buy goods for way cheaper than they otherwise could. And that allows them to spend more money on services, whether it's streaming or cell phone services or, travel, going out to restaurants, entertainment venues. And the net effects are actually positive, not negative. Positive.
But there's been a geographic dispersity, which might be reflected a little bit in the politics of the day. Because if I look at the Midwest, my wife comes from Western Pennsylvania, wonderful family, a dad who served for 3 years in World War II, came home, learned a craft. He was an engineer, a tool and die maker, worked in manufacturing for a division of General Motors, had a beautiful suburban ranch-style home, 2 cars, active at the VFW, active in his community, made a good living, was able to go on driving vacations once a year, rented a little lake house. I mean, the classic American family. My mother-in-law worked in a bank in her local town. Those jobs don't exist like they used to. Ergo, those people, if they send their kids to college, very few of those kids go to college, return to those communities. They have to go coastal. They have to go to the big cities. And that's had a very big social geographic impact. And I think we've seen that reflected in the divergence in our politics.
You've put your finger, Jim, on why it can be politically popular, because you see those kinds of costs and they're real and they're visceral. Whereas buying stuff for a lot cheaper and being able to spend more money on other things is not as kind of visceral or obvious. But let's keep in mind, you're right. A lot of those manufacturing jobs have been lost. But what's happened? America is a leader in tech. It's created a whole bunch of new jobs, and that's a higher value added industry. And by the way, one thing I didn't talk about in terms of free trade that is even more sort of obscure. So how does America have such a low saving rate but such high investment? How have we become a leader in tech if we save so little? Well, here's why. All that trade deficit with all the money, net money going abroad, comes back big time we have a capital account surplus. So foreigners buy a lot more of our assets than we buy of theirs. What does that do? So foreigners own a third of US treasuries and 20% of our stocks and bonds, 25% of our corporate bonds. I mean, what does that do? That increases the supply of loanable funds or savings in the US. They're investing here. And that, so we were able, now it obviously helps a lot that the US has by far the biggest, most liquid, safest financial markets in the world. I mean, that's why they could be selling the dollars, but they poured back in to savings. It's been a great deal if you think about it. We get these, we can consume a lot, which keeps current growth very strong, but we also are able to invest a lot, which no other country can. So I don't think that's really appreciated. Again, I get it, Jim. I know. I lived in Ohio for 6 years. I know what the industrial Midwest went through. And let me say one more thing. One of the keys, if you go back, what's made America so wealthy and profitable and all that stuff, it's the ability to withstand that social change. To this day, Europe subsidizes farming much more than we do. Time of the American Revolution, well over 90% of Americans were farmers. The Industrial Revolution was a huge social upheaval. People used to spend their lives on farms, your kids, your grandkids. They moved to cities. We built all these factories and we were a leader in manufacturing. Well, this is another change like that has allowed America to lead in tech, which has been hugely beneficial.
It's a higher value add, right?
Social media. But, this is how America, they're able to do that. It's hard. Yeah, and you see this. It's not easy. It does, and it's probably had a big effect on our politics. I think you're absolutely right, Jim. It is a tough social transition, but it's allowed America to have all this wealth.
So the critical question, Jim and Larry, is what now? And I think when that question's asked,
and now at different points in time.
Yeah, but we can ask, the administration to wind it back. They went too far.
Yeah.
I think going to this extreme has proven to be a debacle for our economy.
But we have seen Argentina,
and they can wind it back.
And Argentina and Vietnam have stepped forward quickly. Malay and Argentina say, "Hey, I'll go to zero if you'll go to zero."
Right.
Will there be a lot of trading going on here, Bob, Larry?
Well, my worry immediately is more on retaliation.
Yes.
Where this becomes nasty or nastier, because I think, to be fair, it was our country that started getting away from the economics of fair trade, which is, do you need a bit of a tariff to even off, say, a VAT, a value add tax, or China subsidizing the banks? So there is some tariff, something below 10% probably that might make some economic sense, but we're way beyond the economics. It's now into retaliation.
It's political.
Yeah.
I wonder too, thinking some moderate case, not quite where we are now, something lesser going forward. Who does that hurt more geopolitically, economically, Larry? Which country? I think China, which we know imports more than 75% of their energy and more than 75% of the food and foodstuffs. Doesn't this clobber them more so than other people with their
that's a
$1 trillion trade imbalance?
And that may be sort of what the administration's counting on, because it is true that most of these trading partners we have count more on trade than we do.
Yes.
It's relatively small. And so if you look back, so here's what it is. It's a lose-lose. Everybody loses, right? They lose more than we do. Now, trade's been a win-win. Now, one reason why America's gained more than most others is a different point, which is that we have these huge capital markets, so this money comes back in spades. So other countries don't have that benefit. But it is true. In the last one, this hurt. We went into a manufacturing recession in 2019 after the retaliatory tariffs. Nobody noticed because COVID then came and everything fell apart. But it hurt our the very industry we were trying to protect, and that'll happen this time. By the way, the EU is not far behind China. They're going to put on retaliatory tariffs. No question about it. And so that's going to hit our industries. When you say who's hurt, I'd look at more industry, agriculture, definitely. China buys a lot of soybeans, pork. It happened last time. In fact, the Trump administration had to subsidize American farming. If you remember, they sent billions of dollars to farmers to try to offset the harm there. Manufacturing will be hurt, no doubt about it.
The
Technology,
difference now is you have the production in Ukraine off market.
right? Well, we actually have a services surplus and sell a lot of services to other countries in tech. Microsoft, all that stuff. And that wasn't counted in the formula, by the way. So now Bob brought up a very interesting point, and that is other countries, if you look on average, it is true what the administration says, that other countries on average have more tariffs than we do. If you add in restrictions and import quotas and subsidizing, as Bob says, China's subsidizing. But it's not that big of a difference, first of all, nowhere near the kind of tariffs we're putting on. And it really hasn't had much effect on trade flows. What really affects trade flows are things like relative labor costs, relative demand. The U.S. usually is stronger than other economies. That means you import more. I mean, so those kinds of things, relative interest rates, all those things really are the things that drive trade, not the differences aren't that big, but they are. It is true that we have, on average, if you count everything, a slightly lower tariff, but it hasn't been driving trade flows.
You talked about Circle and you talked about the impact on financial services firms and IPOs. We see that Klarna, which was supposed to go public this week, pulled their deal. And it's a great company. I'm an investor. I'm a big fan of Sebastian, the founder, CEO there. So I think it'd be smart to pull out. Is this crazy market to think about holding your first public offering in. But talk about correlation of Bitcoin. It was supposed to be an uncorrelated asset. Larry, it seems to be awfully correlated. And I think back to the beginning of this year, your friend Tom Lee forecast that he predicted that Bitcoin would end this calendar year 200 or above. He said it wasn't out of the realm of possibilities. At that time, it was about 110, that it would go back to the 70s. And lo and behold, here we are in the 70s of Bitcoin. Larry, correlation or not? What happened?
Yeah, so I look at Bitcoin as sort of like gold. It's just in a sense that it's just a speculative asset. I mean, I don't know if you know, but like as a medium of exchange, it's less than 1% of what people use for spending in the world. And it'll never be a main thing. Now, Bob mentioned Circle. Stablecoin is different when it's pegged to $1 or something.
And how is it different, Bob? Stablecoin is what?
Well, people aren't speculating on the price of a U.S. digital
It's a
coin.
utility?
It's backed 100% by dollars in a money market of one, managed at BlackRock, access to the Fed window. A dollar is a dollar is a dollar. It doesn't move.
Right.
And it's really used for transactions. And it will dramatically improve efficiency of international trade and efficiency of bank-to-bank business, but most importantly, the efficiency of business-to-business businesses.
Right.
I think, to Larry's point, what I found fascinating when I got up this morning and thought about talking with you guys is
and
the
that
stock
other stock you
markets.
had at some other show, CNB something?
They just squawk on there. I don't know. But you look at the stock markets around the world down 4% for the third day, but gold is down, Bitcoin's down. This is the classic risk-off trade. Right now, there is not a port to hide from the storm.
So, Larry, you gave a good picture of where we were before tariff mania. We're in the midst of tariff mania. It's likely to last another couple of few months would be my guess. What do we look like on the other side?
So, I mean, a lot of it depends. I don't claim to be a political expert. I mean, Bob brought up, the idea this can be reversed. He's right. It can be. And by the way, there's other routes, not just the administration.
I see a copy of the art of the deal on your credenza behind you.
Come on, Jim. Anyway, no, but what I was saying is, Congress might. I just noted the Senate already voted to change the Canada tariff to take over that power from the president. I think it's going to go to the courts. A lot depends. Look, if this, let me put it this way: if this is sustained at these levels, there's a very high probability of recession. One of the things that everybody knows about the stock market, but as I said, it was floating in the clouds before. What's impressed me in terms of market expectations are, one, now we've got the market's pricing in 5 rate cuts this year. What's really interesting is bond yields have gone down. Now, the one thing is for sure with tariffs is prices go up a lot. What does that tell you? That tells you markets are more concerned about growth than they are about higher inflation if bond yields are going down.
That's how you interpret that. I got you.
Yes. And so along with credit spreads widening, the dollar's going down, even as trade deficits are expected to narrow. That's another thing, confidence in the U.S. economy. So I think the recession probability is very high if this is all sustained. Now, if you put it all together, it's very possible that it doesn't last very long. We've got midterm. At some point, they're going to have to start worrying about midterm elections, and the economy tanking is not going to help them. So you actually, Jim, you brought that up the other day in a conversation. You're right. So again, you got to mix this with, are they going to be sustained? Because as I mentioned before, besides the tariffs, the economy was very resilient. So not booming. Yeah. Not getting excessive like the stock market, I think, was a little excessive. But
I think you termed it pre-tariff mania as the Larry David economy. Pretty good.
Right. So that's the question. I mean, if these things these are so big. I mean, Bob and I have both alluded to the kind. It's 10 times the tariffs we had before. Look at China, by the way. An extra 54% on top of the tariffs that were already there. You're talking about an average tariff rate of about 70%. I don't know about you, but when I buy stuff on Amazon, half of this stuff's made in China. I mean,
And the other thing they eliminated, Larry, which I took note of last week, was the de minimis clause. And that allowed for Temu, Shine. I have a friend in the bridal gown business. And his manufacturers in China became his competitor because you had this $800 threshold that if the value of the good was below $800, no tariff. So that allowed his manufacturers to become his competitors, sell the dress directly to the bride. He had the manufacturer's margin, and now he had almost all of the retailer's margin because he had no tariff, whereas the retailer who was importing it, obviously valued more than $800, he was paying the full tariff. So that elimination, a little note I read in the last few days, changes a lot of things to impact what we pay for things on Amazon.
Right.
So let me ask you this, gentlemen. A wise man that we both know, Charles Scalaro, works with Mike Menard over at the Wellspire. What he said to me over the weekend was, Jim, if you really like the company you own the stock of and you think it has a bright future, he said, why would you think of selling it unless you thought it was going to go down to more than 30%. I said, why is that, Charles? He said, because you're going to pay a 30% tax. So if you think it's not going to go much below 30% on the debt, why would you think of incurring that tax and maybe missing the bounce? And that's modified my thoughts. I looked through the portfolio. There's a couple I think I should rotate out of, but mostly I really like the companies I'm invested in. And so why pay it? It's got to go more than 30% to make it a neutral from a tax point of view. Why not hold pat? Bob?
Well, I think that's why you look at the fundamentals. What is the impact in the economy? I think in terms of the stock market, the three of us have agreed on two things. One is it was probably a bit frothy. Yeah, right. It was a bit frothy, so some of that, but it's corrected more than that. Yes. But let's hold that. Ultimately, the value of these companies is going to be a function of the economy and how well the companies are run. Mm-hmm. I have tremendous confidence in this country, in this economy, in its resilience, and I think we'll see a lot of effort put into getting them wound back somewhat and get them more rational. So I would very, very much say people should not be selling things where they see value, where they see good companies. And I'll come back to what I started with earlier.
Don't look at your statement until the end of the year.
Well, to put it where?
Yeah. Larry, what are your takeaway thoughts here?
Thanks, Matt. I mean, I'll say two things. One, if you Google a long-term chart of the S&P, these big moves that Bob was talking about, Black Monday, financial, look like blips. They really
Yeah.
do. And so part of it, what that says is part of it, and the capital gains tax is a great point, Jim. I mean, I'm in that situation. I'm sure you guys. I don't have any stocks that haven't appreciated a lot, and that
Yeah.
30%. But the other thing I'd say, if you're giving advice to people, time horizon's important, and
Yes.
age, and that kind of
Yes.
thing. I mean, yeah, it'll come back. I mean, at some
Yeah. If
point.
you had a retirement date of May and you were going to start clipping coupons, it's not having an impact on you. It's having an impact on how you think, at least.
Right. So I'd say time horizon is also important. But everything you said is right. I mean, over the long haul, the U.S. has a huge amount of advantages. When I was running research at Barclays, my equity analysts in Europe and Asia were always telling me that valuations are much cheaper there and we should bet on it. It nenever worked. I said,
Yeah.
there's a reason why the valuations are
Still
lower.
cheap.
It's still cheap and it'll stay, America, you look over the decades, even though people talk about diversify, it's paid to be in the U.S. in stocks.
Yep.
It has. So, and if we go into a recession, it's going to be bad for a while. So,
Larry Kantor, Bob Diamond, Atlas Merchant Capital, thanks for your sage and sober advice that I asked for at the very beginning. It sounds to me like if it stays the way it is, this could be quite bad from your estimation, Bob. But Larry, what you and Bob are both saying is take a breath, step back, look at the underlying asset value, look at the underlying businesses that you're betting on, and let's remember, nothing is permanent. Things are going to look different a week from now, 90 days from now, and certainly a year from now. Thanks for calming us down and backing us away from the ledge. For this quarter's update with Atlas Merchant Capital, Jim McCann, thank you for joining us today.
Thank you, Jimmy.
thank you, Jim.